Another form of long-term debt that corporations can take on to finance activities are mortgages. And mortgages are incredibly similar to long-term notes payable, but there is one huge distinction. A notes payable is a company borrowing cash, and once they receive that cash, they're entitled to do whatever they please with that cash. And a mortgage, instead of buying free cash to do whatever you please with, a company is acquiring a very specific asset, typically a building. And that asset that they are acquiring is the security for the mortgage. So if they fail to pay their payments to whoever they borrowed money from, that party is entitled to seize that asset, to take back the building in the case. Same thing with an auto loan, which is another variation of a mortgage. It's secured by the car. If you don't make a payment, well, then they come and they repo your car and take it back. So mortgages operate in a very similar manner to notes, except they're secured by the thing that you purchased, that one specific asset. And because of that, because there's some kind of security for the lender, they know that even if you flake on your payments, they can always take back the asset and sell it to somebody else. You typically get a better rate of borrowing on a mortgage than you would on a long-term note. So in this journal entry on December 31st, 2018, Smart Touch Learning is going to purchase a building. They are making a down payment in cash of $49,925 and signing a 30-year mortgage for the remaining balance, which is $100,075. They are taking out this mortgage at 6% interest, which is the annual amount of interest that gets tacked on, and it is payable in even $600 monthly payments. And that payment is going to be spread amongst principal and interest. So what are we going to record at the time we sign the mortgage? Well, we're signing the mortgage for the express purpose of acquiring a specific asset, a building in this case. So we're going to put that asset that we are acquiring by signing the mortgage on our books by debiting it. So we're going to debit building for $150,000. Smart Touch is making a cash down payment and also signing a mortgage. So the cash down payment gets credited to cash, and the remaining balance, the amount of the actual mortgage that they're taking out, is put on the books like any liability is put on the books with a credit. So we have two credits, one mortgage payable for the amount that they're borrowing, which is $100,075, and another credit to cash for the amount of the down payment, which is $49,925. And now every time the company makes a payment on the mortgage, you're going to have a portion that goes towards principal and a portion that goes towards interest. The way that I'm going to run this class specifically is have it so that whenever you pay on a mortgage, you see the more common fixed payment schedule. The note that you saw earlier, there was a descending payment schedule. Each subsequent payment got cheaper and cheaper and cheaper. That exists, but it's not the most common thing. The most common thing is the lender telling you exactly how much you have to pay each and every month, and it stays the same for the entire life of your borrowing. Well, that's what's happening here. Throughout the entirety of the 30 years of this mortgage, Smart Touch is going to have to pay exactly $600 a month. Well, now we know that a portion of that is going to go towards principal, and a portion of it has to go towards interest. So to figure out how you're going to break that $600 apart between interest and principal, you need to first figure out what portion of it goes towards interest. And you find that in the same manner you always find the portion that goes towards interest. Take your outstanding principal, your beginning balance during the period that you're making the payment, multiply it by rate, and multiply it by time. This is a 6% rate that we're borrowing at, but these are monthly payments, so time is going to be 1/12. So we take $100,075, multiply it by 6%, and multiply it by 1/12, we come up with $500.38. Well, we know now that $500.38 is going to go towards interest. We also know that our total payment is $600, so the amount that goes towards principal is essentially what is left over out of our total payment after we made our portion towards interest. So if $500.38 of our $600 payment is going towards interest, what's left to go towards principal? $99.62. So the journal entry to record the payment on a mortgage looks exactly the same as the journal entry to record a payment on a note, except now as a mortgage payable going down instead of notes payable. But the amount that goes towards principal decreases your liability. We're going to decrease mortgage payable by $99.62 by debiting it. The amount that goes towards interest is recorded as an interest expense with a debit, so we debit interest expense for $500.38. And our total payment, the amount of cash we're actually handing over to our mortgage broker, is $600. We credit cash for that amount. Let's do another example really fast. On January 1st, 2018, Paradise Pets is going to purchase a new building for $200,000 by signing a 20-year mortgage for the full amount. No down payment happening here. They're taking out a loan for the entire $200,000. The mortgage is at 6%, and Paradise Pets is going to make $1,200 monthly payments. And again, since this is a fixed payment schedule, each month a portion of that's going to go towards principal and a portion is going to go towards interest. But for now, we're only recording the signing of the mortgage. So you debit what you're acquiring. What is Paradise Pets acquiring? They're acquiring the building. They are taking out a loan for the full $200,000 selling price of this building, and you put assets on your books of what you paid for them originally. So that building goes on our books for $200,000, as does the liability. So we have a debit to building for $200,000, a credit to mortgage payable for $200,000, and the journal entry to record the signing of a 20-year mortgage for a building. And now Paradise Pets has to make their first payment. Well, they took out $200,000 at 6%, and they're required to make monthly payments. So we first need to figure out what portion is going to go towards interest. $200,000, the amount owed at the beginning of the period, times 6%, times 1/12 to convert it from an annual rate to a monthly rate, is going to give us an interest payment of $1,000. Well, the total payment that they're making is going to be $1,200. So whatever portion doesn't go towards interest is left over to go towards principal, ultimately decreasing the amount that you are carrying your mortgage payable by. So if our $1,200 payment has $1,000 of it going towards interest, that means there's only $200 left to go towards principal. So we would debit mortgages payable for $200. We would debit interest expense for the interest portion, which is $1,000, and in total we're handing over cash of $1,200 to the bank to pay off our mortgage for the period.